You are listening to The Vocal Technologist. Spoken tech for your ears.
Visa is cutting 2,600 jobs to pay for AI, while another company just valued itself at $115 billion. Let me explain.
The physical infrastructure of money is, it's being completely rewritten.
Yeah, right. So as your vocal technologist, I was picking through some research, listening to heaps of industry podcasts, shows like Payments on Fire, Consumer Finance Monitor, Fintech Hustle, and, Cheeky Pint and Leaders in Payments. I really wanted to untangle how artificial intelligence is moving from this like shiny toy to the actual plumbing of our money.
Right. It's moving from the theoretical to the structural.
Exactly. We're going to get right into the guts of it, starting with a pretty massive tension between human jobs and, well, silicon.
Yeah, and that tension it's no longer just a thought experiment. If you look at Visa's massive operational shift, they are eliminating roughly 7% of their workforce.
Which is huge. That's what, about 2,600 jobs?
Exactly. And mostly across their technology and product teams.
And they're doing this specifically to fund their AI transition, right? Redirecting that cash into cross-border payments, business payments, stable coins. So we're talking about digital dollars moving on blockchain rails to bypass those slow correspondent banks.
Yeah.
But, I want to suss out the human cost here because it feels pretty brutal.
It does. But it's vital to understand the underlying mechanics of this decision. This isn't, it's not standard corporate cost cutting to just pad a margin.
Right.
Visa is looking at processes that historically required entire floors of human analysts. Think about fraud detection, routing optimization across global networks.
Compliance checks, all that stuff.
Yeah, exactly. They are realizing the computational infrastructure can handle the heavy lifting far more efficiently. So by stripping humans out of the maintenance loop, they can reallocate capital toward pure network expansion.
Visa clearly has the massive capital required to do this properly.
Yeah.
But looking across the broader startup ecosystem, we have a very dodgy issue.
The AI washing.
Spot on. Every startup and their dog claims to be AI native right now. It's like plastered on every single pitch deck I read.
Well, it's purely a marketing label for most of them. To cut through the noise, HackerNoon proposed a really brilliant concept called the removal test.
Okay, what's that?
Basically, if you take a financial product, strip the AI layer out of it, and the product still basically functions.
Right.
Maybe it's a bit slower or clumsier, but the core logic holds. Then it isn't truly AI native.
I love that. It's like gluing a cheap plastic spoiler onto a beat-up old 1998 hatchback and calling it a race car.
Exactly.
Like, it might look fast, but you haven't actually changed how the engine block performs.
Yeah.
A true AI native build means what? Redesigning the entire engine from scratch.
Precisely. True AI native architecture in finance means embedding compliance, explainability, auditability into the absolute core of the system from day one. You can't just bolt those things on later.
Because regulators won't wear it.
Right. When regulators audit a bank, that bank needs to explain exactly why an algorithm denied a loan or, flagged a transaction. If the AI is just a wrapper draped over legacy code, that level of explainability is basically a mathematical impossibility.
Yeah, that black box problem is exactly why the real money is flowing into the underlying pipes. Like, Stripe is in talks to buy an AI model marketplace called OpenRouter in a deal that's potentially valuing the startup at $10 billion.
Which is a massive play for infrastructure.
Massive. OpenRouter helps developers route requests across different AI models seamlessly. So Stripe clearly wants to be the toll booth here. They want to control how developers select, access, and crucially, pay for model usage.
Yeah, controlling the transaction layer of AI.
Right. But then you have MoonPay launching something called Paybox, which feels entirely different.
It is. Paybox is fascinating because it tackles a completely different architectural problem. It's essentially a payment vault built specifically for AI agents. The idea is that an AI agent can execute transactions on the open internet without forcing the user to leave their conversation or, manually approve every microtransaction through a two-factor prompt.
Right. I've got to push back on this. Are we really ready for bots to have their own wallets?
It's a leap. For sure.
I can't help but wonder if the tech bros are having a lend of us here with the security risks. Handing a machine its own credit card sounds like a recipe for waking up to a completely drained bank account.
The security concerns are incredibly valid, but you have to look at the friction this removes. If we are moving toward a world where your AI assistant negotiates your software subscriptions or optimizes your utility bills by switching providers,
Right.
or handles your travel logistics, it needs a secure, ring-fenced environment to execute those payments. It can't pause to ask for your thumbprint every time it optimizes a $3 software cost. Paybox is attempting to build that isolated environment.
But trusting a bot to handle microtransactions in the background, I mean, that leads us straight into a much bigger concept, the primary banking agent.
Yes, the holy grail of consumer fintech right now.
Exactly. Right now, most consumers are juggling about 3 different bank accounts, maybe a brokerage, a few payment apps. It's a bit ordinary trying to keep track of it all. The vision here is an AI agent that orchestrates your funds across multiple institutions for you automatically.
And the driver behind that vision is actually regulatory avoidance.
Wait, really? Avoidance?
Yeah. The massive AI labs building these incredibly smart foundation models have zero desire to hold your money. Taking custody of consumer deposits triggers a compliance nightmare of know your customer and anti-money laundering laws.
Oh, right. So they want the data, not the regulatory headache.
Spot on. So the ultimate winner in the consumer space will be the company that seamlessly integrates a heavily regulated bank account underneath a highly capable, transparent AI agent.
I'm still feeling a healthy dose of skepticism here, mate.
Yes.
The idea of trusting an AI to move my rent money around automatically makes me sweat.
Understandably.
Like, what if it hallucinates, misreads some promotional email, and just dumps my savings into a volatile meme coin?
Well, you aren't the only one worried about that scenario. Consumer Reports is actively pushing for a mandated duty of loyalty for these AI assistants.
Duty of loyalty.
Yeah. As financial agents become more autonomous, they are arguing for a strict fiduciary safeguard. The AI must be legally and structurally bound to prioritize the consumer's best interests above all else.
Meaning, the underlying code can't be designed to just maximize engagement, and it can't quietly steer you toward whatever personal loan give the host bank the highest profit margin.
Exactly the opposite. It requires strict data minimization and total algorithmic transparency.
Right.
Financial institutions are under immense pressure to build this architecture securely now, because if consumer trust breaks down here, regulators will swoop in and freeze the entire market.
Yeah, that makes sense. Hey, if you're finding this chat useful, toss us a subscribe. Helps us keep untangling this stuff for you.
The scale of what we were discussing is pretty unprecedented, honestly.
It really is. And it raises a massive question. When you look at the sheer scale of these consumer platforms, why isn't there a trillion-dollar fintech company yet? Like, we have trillion-dollar tech companies, but fintech seems, I don't know, capped.
It comes down to borders and narrow product suites. Historically, financial regulation limits global scale.
How so?
Well, a bank built for European regulations can't easily operate in South America without deploying entirely new infrastructure, localized compliance teams, distinct capital reserves.
Ah, right. It doesn't just copy-paste.
Exactly. Those geographical barriers weaken platform lock-in. But AI, combined with tokenization, representing assets as digital tokens that move instantly across borders, that's finally changing the math.
And we're already seeing the scale accelerate, aren't we? Revolut is raising its valuation to a staggering $115 billion through an employee secondary share sale.
Yeah, a massive jump.
Huge. They priced the shares at $2,017 each. That's up more than 50% from their previous mark. And crucially, they secured their first Asia-Pacific banking license down here in Australia.
Which is a huge milestone.
Yeah, that isn't just a plaque on the wall. It means they can hold local customer deposits and lend directly, bypassing expensive intermediary banks in the APAC region.
And a $115 billion valuation cements Revolut as Europe's most valuable startup. Securing that Australian banking license proves to investors that they can actually solve the localized compliance puzzle I mentioned earlier.
It clears a path for genuine global expansion.
Precisely.
Then you have Elon Musk pushing his everything app vision with X Money. It's rolling out for premium subscribers, combining peer-to-peer payments, wire transfers, an FDIC-insured account, plus a Visa debit card with 3% cash back and a 6% APY.
The yield is the real hook there.
Right. Giving people a massive 6% return on their cash natively inside a social media platform. I mean, that completely changes user behavior. You never have to leave the app.
It's the super app model we've seen dominate parts of Asia, finally making a viable play in Western markets. And the incumbents see this threat clearly.
Oh, they have to.
They do. PayPal and Amazon are rolling out buy now, pay later options for eligible customers in Germany and Austria. They're embedding flexible credit directly into the checkout flow to capture consumers before they ever reach for a secondary app.
Yeah. Now, consumer apps definitely get the flashy headlines and the huge user numbers. But the quiet part nobody is saying out loud is that the real path to $1 trillion runs straight through the messy, incredibly boring world of corporate back offices.
Oh, absolutely. B2B is where the actual war is happening.
Yeah.
Corporate finance remains heavily fragmented and so reliant on manual data entry. American Express is actively increasing their marketing and technology spend by 10% specifically to defend their turf in the mid-sized business segment.
Because they're feeling the heat.
Exactly. They are facing intense pressure from highly automated competitors like Brex, Marqeta, and Ramp.
And Ramp is a perfect example of why this matters. They're entering Canada, offering dual Canadian and U.S. dollar cards. But the real kicker is the automated tax coding for GST, HST, PST, and QST.
Which is no small feat.
No, Canada has a notoriously complex provincial tax system. By automating the accounting workflows, Ramp is saving mid-sized companies thousands of human hours that they previously spent categorizing receipts. I mean, it sounds dull until you calculate the capital it frees up.
Right. And we see that exact same drive to eliminate manual friction in physical logistics. Visa and Airwallex are partnering to embed cross-border payments directly into freight software.
Oh, this specific use case is wild. International freight settlements drag on for weeks on end, and the payment administration alone accounts for nearly 20% of total transportation costs.
It's a massive drag on efficiency.
Right. It's like waiting ages for your mate to finally transfer you cash for a pub parma, but on a multi-million-dollar scale. The capital is just locked up in transit, which completely paralyzes the logistics business.
Yeah, so by embedding multi-currency capabilities and working capital tools directly into the software that manages the physical shipping containers...
They're fixing the root of the problem.
Exactly. Visa and Airwallex are replacing armies of clerks reconciling spreadsheets. They are eliminating the settlement delay, providing the financial liquidity that lets global trade actually move efficiently.
But tech alone doesn't solve the human drama unfolding in corporate finance. There's a Barton Partnership survey that looked at CFOs at private equity-backed companies, specifically those in the $100 million to $250 million revenue tier.
A notoriously difficult phase.
Yeah. A full 20% of those CFOs report severe misalignment with their private equity sponsors.
Yeah, that revenue tier is an incredibly complex phase for a company. The operations are highly complex, but the internal finance teams are often terribly under-resourced.
Right.
Private equity sponsors operate on very aggressive transaction timelines. They demand steep margin improvements, and they force CFOs to take on massive operational responsibility without the necessary budget.
That's an absolute pressure cooker.
It really is.
Yet the private equity firms themselves are absolutely flush with cash. Like, Francisco Partners closed $21 billion across its flagship and agility funds. The capital exists. It's just being deployed in a way that squeezes the executives managing it.
Yes.
And that same pressure to find wild new revenue streams is trickling into the startup world. I'm genuinely stunned by Corgi, by the way.
Ah, the insurance startup with the rather unconventional business model.
Unconventional is putting it mildly. They reportedly raised money at a $4 billion valuation in their third consecutive funding round within a terrifyingly short time frame, like 8 weeks.
It's a staggering pace.
They nearly tripled their valuation, but their projected revenue growth relies on combining an insurance model, data room software, and physical coffee shops.
Yeah.
That's heaps of random stuff in one bucket. I'm completely baffled by how a coffee shop fits into underwriting.
Well, on the surface, it sounds absurd, but if you dig into the mechanics of physical retail, a coffee shop provides localized, high-frequency data.
Okay, like,
It captures foot traffic patterns, point-of-sale transaction density, neighborhood economic health. Investors are willing to fund highly capital-intensive models if a company can harvest unique, proprietary data streams that feed back into a more accurate insurance risk model.
wow. Okay, so while startups are experimenting with coffee, seasoned veterans are making highly targeted infrastructure plays. Like, Stripe's very first employee founded a fintech called Increase, and they just went out and bought their own community bank outright.
Yes.
Meanwhile, Coinbase promoted Rob Widoff to Chief Technology Officer after he successfully ran their platform division.
Buying a community bank outright is a strategic masterstroke for an infrastructure player like Increase.
How come?
The standard fintech playbook usually involves renting a charter from a partner bank. But partner banks can change their terms of service or get scared off by regulators. By owning the underlying banking asset, Increase controls the direct regulatory relationship and captures the full margin on deposits.
Which brings us to the ultimate boss of this entire industry, Government regulation. You can build all the brilliant AI you want, you could automate freight, but eventually you hit the legislative wall.
Regulation dictates the literal boundaries of the financial system. Look at Wise.
Right.
They are a massive, highly established player in international money movement. They applied for a U.S. National Trust Bank charter, and federal regulators rejected it outright over anti-money laundering and compliance concerns.
Yeah, their shares sank over 10% on the news. It's a brutal reminder of reality.
It proves that even the most heavily resourced fintechs face uncompromising scrutiny when they try to step into traditional regulated banking spheres.
Yeah.
Wise has stated they are strengthening their compliance frameworks and intend to reapply, while simultaneously pivoting to build out their stablecoin infrastructure. But it really highlights how difficult the traditional front door is to open.
And the legislative side is just as bogged down. The U.S. Senate delayed the Crypto Clarity Act simply because they ran out of floor time. And just to be completely clear, we're strictly impartial here, just reporting the mechanics of the room.
Of course.
The Senate had to prioritize a Russia sanctions bill and federal nominations, and they are tangled up negotiating ethics restrictions on government officials holding crypto. The result is that crucial market structure legislation is stuck in a total traffic jam.
And that legislative vacuum forces alternative markets to find highly creative legal footholds. Prediction markets are a perfect example of this tension. A federal judge temporarily blocked the state of Minnesota from banning prediction markets within its borders.
Meaning platforms like Kalshi and Polymarket, where users essentially buy and sell shares based on the probability of real-world events happening, they get to keep operating there for now.
Yes. The underlying legal battle is fascinating. The judge ruled that the court needs time to consider whether federal commodities law preempts state-level gambling restrictions.
Okay, so federal over state.
The ruling leans toward federal oversight, but it's a very tightrope walk. The judge explicitly warned that some specific event contracts might not legally qualify as swaps under federal law, which leaves platforms vulnerable to targeted state enforcement.
But the mainstream corporate giants, they aren't waiting around for the legal dust to settle, though. Fanatics is swooping in, agreeing to acquire BGC Group's federally regulated exchange and clearinghouse.
It's an incredibly aggressive acquisition of regulatory certainty. Instead of fighting state-by-state legal battles from scratch, Fanatics is buying a fully licensed, direct path to list and settle prediction contracts.
Oh, wow.
Yeah, they can immediately pair that regulated infrastructure with their massive sports audience to compete head-on with DraftKings and Polymarket.
To cap off all this market uncertainty, we have a massive macroeconomic wildcard thrown into the mix. Citadel Securities expects the Federal Reserve to issue a surprise 25 basis point rate hike under Kevin Warsh. A basis point is just 0.1%, so we're talking about a 0.25% hike. But the broader markets only assign about a 40% probability to a hike happening at all, making this a seriously contrarian bet.
Citadel's argument revolves around institutional credibility. Central banks rely on heavily telegraphed policy moves, but Citadel believes a surprise hike would firmly establish strong inflation-fighting credentials.
Even with soft payroll data.
Even then, Citadel sees persistent structural inflation risks, upcoming energy price increases, and a broadly stable labor market as enough fuel for the Fed to make an unexpected, aggressive move to prove they aren't going soft.
There's a phenomenal amount of moving parts to track here. We started out looking at Visa cutting human jobs, because AI is now capable of managing the heavy operational logic. But the wildest part is what happens next.
Yeah.
We're looking at AI agents getting their own secure payment vaults like MoonPay's Paybox, and eventually orchestrating control of our accounts through the primary banking agent model.
The foundational architecture of the economy is transitioning from human-directed to machine-directed.
Think about the mechanics of that for a second. When your AI financial agent is automatically negotiating a loan rate with a bank's AI agent in the background who is actually in control of the economy, the real shift isn't tech replacing humans, it's tech becoming the primary consumer. Hit notifications if you want to be here when we figure out what that means for your wallet. Vocal Technologists, see you soon.
Spoken Tech for your ears.